Hey everyone, welcome back to another dividend investing video. On the channel, we're always on the hunt for undervalued, quality, dividend growth stocks, the type of stocks we invest in to build our wealth and our passive income. And I've identified three in particular I think are appealing for dividend growth investors for the month of February 2024. Now I want to know down in the comments, what dividend stocks are you buying in the month of February? Let's share ideas with each other. And without further ado, let's dive into these fantastic companies. I think look to be at an appealing valuation, perhaps the ideal time to strike to add to your own dividend portfolio. I'm Nick, and this is the Dividend Growth Income Channel. Thank you for joining me today. I'm not a financial advisor or guru. I'm just a regular guy who wants to share my love of dividend growth investing and building financial independence with passive income. If you could, please do me a favor, smash the like button and subscribe to keep up with future videos. This helps us out more than you can imagine with the algorithm, so we can bring you more quality dividend investing content. First up, we have Bristol Myers Squibb, ticker BMY. BMY is a biopharmaceutical company that was founded in 1887, headquartered in New York City, with a 53-year history of paying uninterrupted dividends. The market has been extremely bearish and harsh on this company in the last year, and I think perhaps overly so. This is one of the largest pharmaceutical companies on the planet. They develop products to provide therapeutic solutions to cancer, HIV, cardiovascular disease, diabetes, hepatitis, and psychiatric disorders, with research labs all over the world. And it's a stock at a 52-week low at the time of publishing. In the last month, shares have dropped about 4.5%. Over the last year, shares have fallen 33%. Now remember, these 52-week lows, they can always go lower. The biggest risk with investing in a company like BMY is its expiring patents, as this is the case with all pharmaceutical companies. Now this is a company that has made 3 substantial acquisitions in the last 4 years. That's Celgene in 2019, Myocardia in 2020, and last year they acquired Karuna Therapeutics. The latter has an exciting antipsychotic drug, KarXT, that is said to treat schizophrenia and Alzheimer's disease-related psychosis, and is awaiting FDA approval later this fall. This is something to watch, as approval projects to boost sales in 2025 by 10 to 15% going forward. So as a result, shareholders have seen some dilution as from these acquisitions, although its latest acquisition is being financed by debt and not by issuing shares. So hopefully this continues in that direction it's been the last few years, these outstanding shares beginning to drop. As far as timeliness, this stock looks ridiculously undervalued by dividend yield theory. Today, investors can get their shares at a near 5% yield. That is 57% above BMY's 5-year average of 3.15%. This could be a historic opportunity to start a position here and lock in that solid yield on cost. Likewise, by PE, we are seeing a massive discount to the 5-year average with a PE of 6.9. This is also considerably lower when compared to the healthcare sector as a whole, which has a PE of 17.6. Right now we have a dividend payout ratio of 34% of forward earnings and 33% of forward free cash flow, plenty of room to cover the current dividend and still pay down the debt they are taking on to fund their new acquisition. Today we have a Simply Safe dividend safety score of 70, was recently downgraded from 79 a couple months back just due to this recent acquisition and the extra debt they're taking on, but still rated a safe dividend, unlikely to see a dividend cut. Solid track record of dividend growth. We see 17 consecutive years raising that dividend payment, 5-year average annual growth rate of 7%, very respectable. The latest back in 2013 of December announced was 5.3%. BMY falls on the quarterly dividend payout schedule in the months of February, May, August, and November, paying 60 cents per share, total annual payout of $2.40 per share. I think even if you weren't sold on the dividend safety, this could be massive upside from where shares are today, and I like the proposition right now. Wall Street analysts see an average of 24.45% upside from where shares are today, with a price target of $60.62. I think this is a very similar opportunity to what you see with Pfizer, ticker PFE, down in a similar way at a historic yield. Buying into these beaten down but quality companies in 2024 could end up paying massive dividends with a lot of upside to boot. Interesting, and I thought you guys should take a look. Perhaps add BMY to your watch list. Okay, the next stock is Starbucks, ticker SBUX. It is the world's largest coffee house chain. Based out of Seattle, they operate in over 80 countries. At present, there are more than 83,000 stores worldwide, and their current strategy is to hit 50,000 stores in the next 5 years. Ambitious. much of that growth in China and India. Starbucks is also a solid dividend growth stock, returning profits to shareholders uninterrupted for the last 13 years. The market has not been kind to Starbucks over the last year. It's down about 12%. Shares are a few dollars above the 52-week low of $89 at the time of publishing. And here's a 10-year total return chart from Seeking Alpha. It shows that Starbucks has brought back 195% on its shares. This slightly underperforms the broader market, which brought back 224%. But notice for the majority of this time, Starbucks beats the market. Only occasionally has performance dip below the S&P 500 over this last decade stretch. It could mean nothing, but I think it's notable. Starbucks looks undervalued right now by multiple metrics in terms of PE. It's trading at 21.8, which is a heck of a discount to its 5-year average PE of 29. It trades at a premium to the consumer discretionary sector as a whole, but we're talking about Starbucks here. We expect to pay some premium for the value in their brand, which is iconic, I would argue. By dividend yield theory, Starbucks looks enticing as well. 23% above the 5-year average yield. Shares are right around the 2.5% yield. This could be a wonderful time to get a historically high yield on Starbucks. This dividend takes up 54% of forward earnings, 64% of free cash flow. No issue here covering that dividend. And management has been bringing this down over the last couple years. We have a simplysafedividends.com safety score of 67, rating the dividend safe, unlikely to face a dividend cut. They weren't paying a dividend in the last recession, but it has been paying the dividend for 13 years and growing it for each of those years. We have a 5-year average annual dividend growth rate of 10% per year on average. In recent years, the dividend hikes have been on the high single digits, and as Starbucks matures as the company, I think that's more reasonable expectation going forward. Starbucks dividend payment is made on a quarterly schedule in the months of February, May, August, and November, 57 cents per share for a total annual payout, $2.28. Starbucks has seen an impressive top-line growth over the last decade. In 2014, they had $16.4 billion in sales. In the last 12 months, more than double what they did 10 years ago, $36.7 billion in revenue. Shares outstanding have decreased significantly in the last decade as well, going from 1.53 billion shares outstanding today, where they have 1.15 billion shares outstanding. That's a 25% reduction in shares. We have a strong return on invested capital. 2020 there, kind of an outlier year, but we have to allow for that given what happened that year, right? Otherwise, consistently over 25 to 30% every year. Fantastic. Could be some upside here as well. The analysts predict an average price target of $106.95, about 16% upside from where shares trade today. And Seeking Alpha author Brad Thomas is even more bullish on the company. He's making the case in an article he put out today that he sees a 30% return potential in Starbucks. You can actually use the link in my description for a free trial if you want to read that article and more. Starbucks is definitely one of those buy and hold forever dividend stocks, and in my opinion, right now is looking to be about as good of a time as we've seen in the last 3 years or so to be buying Starbucks, or at least to add it to your watch list. All right, stock number 3 is Comcast, ticker CMCSA. Comcast is the largest American multinational telecommunications and media conglomerate, the second largest broadcasting and cable television company in the world by revenue. It is also the US's largest internet service provider, very important. And I think it's a terribly underrated dividend growth stock with a strong 15-year dividend growth track record. This is a stock I've been buying. I'm going to be buying more here in the month of February. Unlike the other two companies we discussed, this is not one that's been beaten down. Shares are up 13.5% over the last year, but this itself doesn't mean that the company isn't undervalued, even as it sits a few dollars shy of its 52-week high. I think it's a great long-term opportunity. Today's shares are trading at a PE of 10.6. This is quite a discount to its average PE of 13.7, and also an even greater discount to the communication sector as a whole, which trades at 18.2. By dividend yield theory, Comcast looks to be around 27% undervalued, with a current yield at 2.76%, while the 5-year average is at 2.17%. And this to me is an ideal time to buy a company when you can get it at a better than average yield compared to itself. Payout ratios look great for Comcast, 29% of forward earnings, 38% of forward free cash flow, extremely consistent payout ratios for Comcast, so their dividend payment is easily covered. SimpliSafe dividend safety score for Comcast is 89, rated very safe, making a dividend cut highly unlikely. And Comcast came out with a dividend raise just a couple weeks ago, a nearly 7% hike. 5-year dividend growth rate is an average of 9%. That's 15 years of uninterrupted dividend hikes. Comcast pays its dividend at a quarterly frequency in the months of January, April, July, and October, in the amount of 31 cents per share for a total annual payout of $1.24 per share. Free cash flow per share has nearly doubled in the last year, which has helped fuel that dividend growth. And this is what we want to see continue into the future. We also like to see these share buybacks going from 5.24 billion shares outstanding in 2014. Today there are 4.15 billion shares outstanding, returning value to shareholders both with dividends and buybacks. Love to see it, and I'm a happy shareholder here. Another fun fact, owning Comcast also gives you an ownership slice in an NHL hockey team. That's right, Comcast owns both its local hometown team, the Philadelphia Flyers, and its home arena in Philadelphia. Wall Street analysts are overall bullish on Comcast, rating the stock a 4.0 out of 5, a buy. 13 analysts rated it a strong buy, 4 a buy, and 13 a hold. And like the other stocks we've been talking about, the analysts see an upside with Comcast as well. The average analyst price target is $50.72, with 13% upside from where shares trade today. So Comcast belongs on the watch list of dividend growth investors who want to increase their exposure to that communication services sector. There's some low-quality dividend stocks in that sector, AT&T, Verizon, which pay a lot of yield but don't do much else. I think Comcast still has a growth story in front of it, one I plan to hold for at least the next 10 years and beyond, assuming things remain in the right direction with their business. Now, speaking of that communication sector, there's another company in the sector that has now become a dividend stock. That is Meta, aka Facebook, paying out their first dividend this March. And if you want the details on that and whether Meta is a buy right now in my opinion, go ahead and click into this next video. Thank you so much for your time and your support. And until next time, my friends, keep investing.